I'd like to take a few minutes to work through two of the exercises that are due on our next class day, so that would be next Wednesday the 15th. There are two exercises that I think I could help you with. I will do one in this video and then I'll post a second video for the other one. The first one I want to look at is exercise 11-3A. This deals with partnerships and it could be a little bit tricky about how they split up the profit here. So here we have Faith Busby and Jeremy Beatty starting a B&B partnership on January 1. Business acquired $44,000 in cash from Busby, $66,000 from Beatty. Those were the contributions they made to the partnership. So that's their beginning capital balance. During year one, the partnership earned $42,000 in cash revenues and paid $18,400 in cash expenses. Busby withdrew $2,000, Beatty withdrew $2,500. It says here, this is important, the net income was allocated to the capital accounts of the two partners in proportion to the amounts of their original investments. So their original investments were $66,000 and $42,000 for a total of $110,000. So Busby is going to get $66,000 divided by 110, that percentage of net income, and the other partner, Beatty, is going to get $42,000 divided by 110 for their portion of net income. So let's go ahead and walk through the problem here. So they're asking you for financial statements. So first of all, here we have a proper header on our income statement, B&B Partnership income statement. Pretty straightforward, $42,000 minus $18,400 gives us $23,600 of net income. And here's the part that's a little bit, well, it's not tricky yet actually. So then we do the capital statement, which is what they call a statement of stockholders' equity for a partnership. It's called a capital statement. So it starts out with zero because it was a brand new business. They have $110,000 invested by the partners, net income of $23,600 from the income statement, and then the owners or the partners withdrew $4,500, so they end with $129,100 in total capital. So here's the part that requires a little bit of math. So now we'll do the balance sheet. So this company, they have $129,100 in cash. I got that number by reading through the problem and seeing how much cash they started with, how much cash they collected for revenue, how much cash they paid for expenses, and then how much cash was withdrawn by the partners. So I ended up at $129,100. And there are no liabilities, and then their equity. So this is the part I wanted to show you the math on. Their equity works out to $51,440 for Busby and $77,660 for Beatty, which thankfully totals $129,100. So what I want to point out to you is how I arrived at those numbers. So for Busby contributed $44,000 worth of capital, and then here they're getting $44,000 divided by 110, that proportion of net income. I simplified that to 44 divided by 110, times the $23,600. So they're going to get that portion of the $23,600 net income minus the $2,000 they withdrew. So Busby ends up at $51,440. And the other partner, Beatty, contributed $66,000. That partner is going to get $66,000 divided by 110 times $23,600, so that portion of net income, minus the $2,500 that partner withdrew, so they end up at $77,660. And then I can double check that I've done my math correctly by the fact that they add up to $129,100, which is what our total equity is. So hopefully that makes sense. I will scan this and put it on Moodle as well. I hope you found that helpful.